Hello, everybody. Welcome to today's Lunch and Learn webinar, Provider Relief Funds and Medicare Bad Debts. Today's session is sponsored by Craft CPAs. Today's date is March the 3rd, 2022. My name is Mark Lynn. I am a consultant from Chattanooga, Tennessee. I work with healthcare business specialists. We thank you for attending these Lunch and Learn sessions. Danny Gilbert will be with us today. She'll be answering your technical questions on the sidebar there. And if you have questions for Jordan or Trent, please put those in the question box and Danny will ask them at the end of today's session. What Healthcare Business Specialist does is we prepare Medicare cost reports. That's what I'm going to talk about 1 minute here is it is time for cost reports to be due if you're 1231. And the deadline this year is May the 31st. That deadline is not changing. In the last few years, they've been extended by 2 months, and we've not been seeing a lot of cost reports come in. So let's think about cost reports and get that information into us, or if you use Craft, get those into Trent, because we need to see those cost reports so we can get them out the door. If you've not joined the Facebook group, there's about 3,500 members. That is a great place for you to ask questions and get answers from people like Jordan and Trent and Patty Harper and Charles James and Danny Gilbert and all the great people that will help you out on there, and your peers as well. We've already talked about questions. Just type them over in the pane there, and Danny and I will be watching it as well and try to answer any questions we can as you go through the webinar, so you'll have those answers too. Everything is current as of today, and so let me see here. Where you can find the slides, they will be on our website at ruralhealthclinic.com, RHC webinars. I've already loaded all the slides from these presentations here. We are recording this session, and once it's over, we will put it where the placeholder is for that. So you just give us a couple hours, and we will do that. For next week's webinar, we are going to have Danny Gilbert is going to do the webinar on TennCare quarterly reporting. If you're in Tennessee, you have to do a quarterly report in order to get your additional TennCare reimbursement as an RHC. And Danny is very good at those things, so she'll be doing that. And then our last webinar, our last Lunch and Learn webinar that we have scheduled as of right now is Joe Lampard from HIPSA Acuum. There's a bunch of changes that are going on, and about 1,000 RHCs potentially will be in an area that's withdrawn for certification as an RHC. What are the implications of that? That's something you really do need to know. As well, if you're planning on moving or doing something different, that is something you're going to need to know, and what the implications of that are. So those are what are coming up. About our speakers for the day, Trent Jackson. I've known Trent for a long time. He's actually worked here at Healthcare Business Specialist. He will be talking about bad debts. He is a certified cost reporting specialist. He actually even teaches classes. And let me turn off that. And so Trent will be talking about Medicare bad debt. So when you're preparing your cost report, you'll know what you need to do to put those bad debts on the cost report. And then starting off will be Jordan Olson from Craft CPAs. Jordan has been so very helpful to our RHCs. We sent over a lot of phase 4 applications to them because we were just too busy to do them. And so Jordan really helped everybody out. He is with Craft in Nashville. So let me, without further ado, let me turn it over to Jordan here. I'm going to make you the presenter, and you can tell us about Provider Relief Fund reporting. Okay, you should be the presenter now.
Okay, is it showing the right screen now?
Yes.
Okay. Where does that go over there?
I think if you hit slideshow, maybe that'll hit slideshow, and then from beginning, that usually helps.
Yeah, it just went onto a different screen. Let me Can you all see my first screen?
Yeah, yes, we can.
Provider relief funds and American rural payments.
Yes,
Okay. So like Mark was saying, my name is Jordan Olson and I work at Craft CPAs. I am on our healthcare industry team. Essentially, we kind of do primarily work with physician groups, hospitals, skilled nursing facilities, and we also work with some RHCs. I do the accounting and bookkeeping side, so anything from processing accounts payable and running payroll to coding monthly transactions and preparing financial statements. Over the past couple of years, we've done a lot of the COVID relief, so PPP loans, helping determine whether practices are eligible for employee retention credits, and then assisting with both the applications and reporting for the provider relief funds. Trent, who we'll talk a little bit later, is part of Craft Healthcare Consulting, which is an affiliate of Craft, and they do everything from revenue cycle consulting to coding and cost reports. So I'll let him talk about that a little bit later. And then we have some other affiliates within our firm that do anything from HIPAA compliance to kind of assisting with IT systems, wealth management, litigation support, and valuations. And obviously, we also do prepare tax returns as well. But today, I'm specifically talking about the Provider Relief Fund and American Rural Payments. I've seen a lot of these presentations over the past year, and a lot of these presentations will go through kind of phase one, what was phase two, what was phase three, what was phase four, how much money was allocated and all that. And for the most part, I've skipped that information through this presentation. I really wanted this to focus on specifically phase four, how the payments were calculated, and potentially if you have an issue with the calculation, what you can do about it, how the funds can be used, and what the reporting looks like. So I'm going to go ahead and get started. First question I think we actually receive a lot is, practice will be like, I got a lot of funds from all these different places. How do I know if I received provider relief funding? So the first thing I always say is anytime you receive funding, look at your actual bank statement. The Provider Relief Fund often says HHS stimulus or HRSA provider relief. And you might also receive an email at the same time telling you that you received a payment. But back in April 2020, when payments just popped into people's accounts, they had no idea what they were receiving or what it was for. So looking at what the actual bank statement is telling you is a good indication. There's also a website, data.cdc.gov, that has a list of all providers that have accepted the provider relief funds. After 90 days, if you have not declined, they just are going to say that you've accepted them. So that's a big note, is that it is public information that you've received these funds. So someone can look up your entity and know whether or not you've received funds and how much you've received.
Hey, Jordan, this is Mark. Your slide is still on the first one. I noticed you're giving the information for the second slide. So I don't know if there's a way to change that over.
Can you see it now?
Perfect. Thank you.
Okay. So, and they have said that they are issuing 1099s for provider relief fund payments. So you should be receiving 1099s in the mail each year. So you should have already received a 1099 telling you how much you received in 2021. I'm going to briefly go through the payment calculations. They're a somewhat complex calc, but really the only reason you would kind of look back to this payment calculation is if for some reason you believe you should have received a different payment based on their methodology. So the majority of payments have already been distributed. If you have not received a payment and you've received an email saying that you are receiving a payment, make sure to look closely at that email. I had one practice that was essentially told they're receiving a payment, but you have to actually scroll down the email and it says that you need to create an Optum Pay account in order to receive funds. So make sure that you're reading all those emails to completion, just to make sure that if there's something you need to do to receive your payment, that you've done it. But essentially for this phase 4, base payments were calculated based on whether you were a small, medium, or large provider. Small being 10 million or less annual net patient care revenues, medium between 10 and 100 million, and large over 100 million. And essentially, depending on what your provider size was, would determine what percentage of your expenses and revenues reported in your application would be would calculate as your payment. And then a bonus payment was the remaining 25% of the fund, and that was calculated based on Medicare, Medicaid, and CHIP administrative claims data, essentially taking 0.3% of the claims in those categories. And then ARP, for the American Rural payment, this is the one that the distribution started back in November, on November 23rd. Essentially, there's a 4-step process that determined how much your payment would be. First, it was that HRSA would price the claims data to eliminate the disparities between the reimbursement rates, and then would also price the Medicare Advantage and Medicaid managed care and counter data at Medicare rates. The second step, HRSA would calculate the number and type of claims per billing subsidiary TIN and multiply them by the relevant prices calculated in step 1. And then step 3, HRSA would adjust the claims-based payments to the amount of funding available and ultimately determine payments. And then HRSA would then aggregate billing TIN's payments to the filing TIN, which is whoever was noted as the applicant on the phase 4 application. So really at this point, the applications are closed. And really the only point that I'm mentioning this, like I said, is because until through May 2nd, if you have an issue with the payment, whether you applied and you didn't receive a payment, or you received a payment that you thought was not calculated correctly, you can complete a reconsideration request form. Essentially, you just need to provide your payment determination letter, the DocuSign envelope ID, which you can look up, your contact information, your TIN, and then the reason you believe your payment was calculated incorrectly. The one thing that they've been very strong noting here is that it has to be that you believe your payment was calculated incorrectly based on the methodology that they published. You can't use this request form to say, I don't agree with your methodology and I have a certain circumstance that you need to consider something differently. Specifically for this request form, you have to use the methodology that they have provided. Terms and conditions, I'm a big fan of reading these. They're actually pretty short. The majority of the things in the terms and conditions are not going to apply to most practices, but you do need to at least just read through. These are kind of the 4 takeaways that I thought were kind of the most important. As I mentioned earlier, terms and conditions are deemed to have been accepted after funds are received and retained for at least 90 days. So if you did not go back in and attest to the terms and conditions and you did not reject the funds, after 90 days they would have been accepted. So for instance, your American Rural payment that you received, if you received it November 23rd, that 90 days would already be up for that payment. Payments cannot be used to reimburse expenses or losses that have been reimbursed from other sources or that other sources are obligated to reimburse. One of the easy examples would be if you received a paycheck protection loan. The PPP program reimbursed some of your salaries. So if you also are claiming those salaries as part of your PRF reporting, you need to make sure that they're not for the same time period. PRF4 and ARP payments must be maintained in an interest-bearing account. This was a new one for phase 4, and essentially any payment you received must be maintained in an interest-bearing account. The one thing I have not received clarification on is that if you already have, let's just say you received 100,000 and you already have the lost revenues or COVID-related expenses to cover that payment, my guess would be that you probably don't need it to be in an interest-bearing account, because you can already say that you used it, because the period of availability even for phase 4 goes back to the beginning of the pandemic. But that is just something you want to consider, especially if you've received funds that you have not used yet or do not have the lost revenues to support. And then for ARP payments, the recipient certifies that it has provided or has provided services to Medicare and Medicaid and CHIP beneficiaries who are residents of rural areas. So hopefully, I'm guessing, based on the fact that we're on an RHC webinar, most of you should be able to certify that, but that's definitely an important one specifically for the ARP payment. Use of funds. So these are some of the categories where the funding can be used. Healthcare related expenses related to COVID-19. So this is think of anything like cleaning supplies, PPE. If you have plexiglass dividers, protecting against COVID-19. If you bought thermometers, if you bought ventilators, all of those types of things will go in the healthcare related expenses. General and administrative expenses, here's the category you need to be the most careful on. Essentially, this is meant to be above and beyond what your normal general and administrative expenses would have been pre-COVID. So they give an example like rent. So your normal rent payment is not a permissible use, but if you, for instance, rented the building next door because you needed a safe place to see patients, or you needed to rent an additional location for maybe your waiting room, for instance, the additional rental related to COVID-19 would be permissible, but the original rental, your original office rent, is not permissible. Under the general and administrative expenses, there's been some really good information that's come out regarding recruiting and retaining personnel. Essentially, I think most of you are aware that there's healthcare employment shortages, and even outside healthcare, most industries are dealing with this, and even some in the healthcare industry are finding themselves competing against kind of like non-healthcare entities like Target or Walmart, or even some fast food stores that are starting to pay $15 an hour for entry-level staff. So as part of the Provider Relief Fund, they're allowing retention pay, so incentive pay, retention bonuses, childcare assistance, overtime pay, temporary housing, transportation, mental health and stress management resources, and other fringe benefits. So hazard pay has been the one that I'd heard about the most, but there's really a lot that you can do, especially if you still have funds to use that can go towards retaining your personnel. And then as far as recruitment, you can pay referral bonuses to your employees if they find a new employee for you. You can play employment agencies. You can have hiring bonuses, and it even says under recruitment salaries for newer temporary staff. And it says that you can recruit and retain positions like physicians, lab techs, administrators, contracted staff. Ultimately, it says allowable uses of funds for personnel costs are broad and flexible. And for me, that's been kind of the probably the most important update that I've seen recently, just because I know specifically with my client base, that's where they're struggling the most, is that they don't have the personnel. So if you still have the funding, that would be one of the areas I would recommend allocating it. And then also, a lot of practices are not aware that taxes imposed on provider relief fund and ARP payments are an allowable use for the funding. So let's just say you receive $1 million in funding, and that $1 million resulted in an additional $300,000 in income tax that were assessed by the IRS. That $300,000 essentially, you can use $300,000 of your PRF funds to cover that additional tax burden. So that one's kind of a new and exciting thing, just because that will help you use a big chunk of the funds. And then with lost revenues under permissible uses, really the things to note here, you need to use your accounting basis. So if you're a cash basis, if you normally do your accounting cash basis, you're going to look at your collections. If you normally do accrual basis, or if you're or you use GAAP, you're going to use net charges. And then when you're looking at your lost revenues, you're going to look at it by quarter and by payer. So I'll get into those briefly in a few minutes, but essentially, for instance, Medicare Part A and B. If from 2019 to 2020 Q1, you had a decline of 100,000 in that category. So Q1 2019, you were at 400,000 in collections, Medicare Part A, Part B, and Q1 2020, you were only at 300,000. That $100,000 loss would be a permissible use of the funds to help you recover that loss. And it's not offset by gain. So if you have another category, let's just say your self-pay, that was actually higher at Q1 2020 versus Q1 2019, that increase does not reduce the amount of lost revenues that you can report for the other categories. The reporting timeline, essentially, if you receive over $10,000 in one of these periods, you're required to report during the reporting time period. So for instance, April 10th through June 30th, that was the first reporting period. You had until June 30th, 2021 to use the funds, and you had till November 30th, 2021 to report on them. Right now, if you received funds between July 2020 and December 2020, you had until last December to use them, excuse me. And the current reporting period, you need to report on these funds by March 31st, 2022. If you do not report on the use of the funds, you will be required to return all of them. And they can also require you to return funds from future periods. So if you received a small $10,000 payment during period 2, and you received $1 million during phase 4, the consequence for not reporting that phase 2 period is potentially that $1 million from phase 4. So I would definitely make sure that you're always keeping track of what funds you received when and when the reporting time periods are. They do send out notices telling you that you need to report, but I can't guarantee that they're sending those notices to everyone that needs to report. They really did not send out those notices during the first reporting period at all. So I would say that this is something that you need to do your best to track, and that they're not going to tell you when you mess up until it's too late. So for the PRF4 and ARP, that most of that was going to be received during period number 4, essentially received July to December 2021. You have till next December to use those funds, and the reporting is going to be January through March 2023. The one big question we have related to phase 4 reporting is if you received funds in 2022 because there was a delay in payment, we do not currently know what the deadline to use those funds is in the reporting time period. So we're still waiting. As of last week when I checked, we're still waiting on clarification to know when that will be due. I have a few more slides and then we can get to some questions. So reporting information to gather. So this is once you're getting ready to report. So if your first payment was phase 4 ARP, then you wouldn't need to report till next year. But I would start gathering this information, especially because it's going to bring to light whether you've used all the funds or if you have more funds you need to spend. So general and administrative expenses by date and amount, and healthcare related expenses by date and amount. The one thing I will note that is if you received over 500,000 in funds, there are specific categories you need to break those amounts into. If you received less than 500,000, you just essentially put one number in the box for general or administrative expenses by quarter, and one number in the box for healthcare related expenses by quarter. But there's a lot more detail you need to do if you received higher amounts of funding. These are the revenue categories. The big thing is when you're running reports out of your practice management system, ultimately the goal is to be able to get your payers into these categories. So being able to run if you're a cash basis payer, just collections by quarter by payer is probably going to be fine. And then you need to make sure that you know how to categorize them into these categories. Interest earned on provider relief fund payments, that's just a number that you report. It doesn't really have much of an impact as long as you can justify expenses or lost revenues related to the interest. Other assistance received, they want to know what you've received related to COVID, so PPP loans, any of the other COVID-19 related programs. If you received anything from Medicaid related to COVID-19, you would report that here. And they're not deducting, they just kind of want to know what you received. And then as far as metrics, personnel metrics, so they want to know how many employees you had, both full-time and part-time, who you hired, who you furloughed, who you terminated, just numbers by quarter in 2 categories, clinical and non-clinical. Patient metrics, by quarter, they want to know how many inpatient admissions, outpatient visits, emergency department visits, and facility stays you had. And then facility metrics, if this is applicable for you, they want to know your staff beds for medical, surgical, critical care, and other. Single audit requirements. Essentially, if you received over 750,000 in federal funding, including PRF and ARP, you would be subject to single audits. The thing to note here is this is funds that you spend. So you either have expenditures to report or lost revenues to report in excess of 750. If you receive 800,000, but when you do the reporting, you end up having to return 100, that would be considered that you only actually spent 700, so you would not be subject to this. But essentially, a single audit is it's an audit of making sure that the funds were used permissibly and that you had the appropriate controls in place. And this must be done by an independent accounting firm. So this is something that Craft, if we are independent, this is a service that we can provide. So feel free to reach out to us with any questions. But if you had received over 750 prior to the phase 1 or phase 2, so prior to 12/31/2020, this is going to be something you're going to need to do for 2021. And then, as I mentioned earlier, if you received funds in January or February 2022 or even March 2022 now, we don't know exactly when that information is going to be provided, but that's something to look out for. There are 85 pages as of last week of frequently asked questions related to the Provider Relief Fund. So obviously I couldn't get into everything, But these are a few of the categories that or scenarios that I think you need to consider, and either feel free to reach out to me if you have any questions and I can help walk through kind of what the scenario will look like, or I can also point you, I'll show some resources on the next page that on the next slide that I can point you to. But if you have subsidiaries, how are you allocating the payments between the subsidiaries and the parent? Mergers and acquisitions, if you received a phase 4 payment or ARP payment over 10,000, you're required to let HRSA know when you have a merger and acquisition. If you have a change in ownership, that's something that you're required to report. Salary caps, if you have someone that's highly compensated, there are limits to how much of these fundings can go towards that highly compensated individual. As I mentioned earlier, interaction with funds from PPP loans, employee retention credits, funds received from FEMA, making sure that you're not reporting on an expense that was already covered by a different program. And then balance billing. The big thing here is that if you had a COVID-related encounter, making sure that you're following the balance billing rules, which essentially look at whether you're billing out-of-network patients more than you would be billing an in-network patient. And I'm definitely not an expert on this balance billing stuff. So we have someone within our firm that can kind of go through that with you if you have questions on that, but just make sure you're aware of kind of what you're allowed to do with as far as billing for COVID related expenses. Lastly, I know, I think I'm doing okay on time, but essentially the reporting portal, HRSA website and frequently asked questions, these are the links to those. And then we also, Craft CPAs does publish some articles. So those articles are available at craftcpas.com/articles. And I know I might have went a little over on time on my half before Trent gets into the Medicare piece. Did we want to go through some questions now, or did we want to?
Yeah, Jordan, I think you did absolutely great. So thank you for that. And we have a couple questions on here that let me undock them so I can read them. Come here. There we go. Amy is asking, how can we double check to make sure we did all of the reporting required if we received money in period 2 or period 3?
Okay, can you say that one more time?
Yeah, how can we double check to make sure that we did all the reporting required if we received money in period 2 and period 3? And I'll tell you what my answer would be, and then Jordan, you can tell me if I'm on par or not. What we did, and I've got a list here of 49 clinics that we did them for. I basically just went into the website, that PRF reporting website that you just showed, and entered in their information and went into the portal and looked, and it has a little schedule there, like the second or third schedule you get to, it tells if you've got money in there or not. And if you got over 10,000, then you've got to go complete everything. If you got less than 10,000, it's going to shut you down and says nothing is required. Hit the button and you're finished with it. So that's what I've been doing for our clients. Does that sound right?
Yes, I would agree. You would just log right into the Provider Relief Fund portal, and it will tell you what payments you received and the different reporting periods and whether you have a report to submit or not.
Yeah, so the key is before March 31st is to check into that portal. It's going to make you change your password. You're going to have at least 15 digits in your password. So I basically just click forgot password, and then you have to put in the tax ID number, and then you just go right in there, and it takes you about 5 or 10 minutes to get through it. So it's really not hard.
And I would actually do that as soon as possible, just because there is a lot of information you have to gather if you find that you have not met the requirements. So
yeah, that's right. Yeah, absolutely. Yeah, we had out of the 49, we had 2 that are going to have to report something, and I'm worried about getting the information in quick enough. So that you're absolutely right. Okay, the next question is, if we did not receive any payments during a specific time period, do we have to report it? I think we answered that one okay. Okay, here we go. If we received 800 grand and spent only 700 grand in fiscal year 2021, which ended December 21, and we use the other 100,000 in 2022, are we still subject to single audit?
So the single audit requirement is based on the reporting periods. So for instance, the single audits for 12/31/21 are based on reporting periods 1 and 2. So it's not going to be necessarily based on, not necessarily based on the, I guess it's kind of, it would be related, the first one would be related to the 2020 payments. But yeah, essentially if you go over, and we don't have, unfortunately, we don't have kind of the information for phase 3 and 4 payments, what those are going to look like in terms of single audits. They've only really talked about 1 and 2. But yeah, the assumption is, like, I think if you've received over the 750, you should probably just be ready and plan on it. But feel free, if you have specific scenario, I can go through, or any kind of CPA that performs single audits can go through and look at when the funds were received and when the reporting makes sense. But it's going to be based on the period of availability. It's not necessarily going to be based on the year that the funds were received or paid.
Yeah, one thing I know we had, and I don't know if we talked to you, Jordan, about it, but I know we had one client that's very small, and they got a $903,000 phase 4 payment. And you know what they want to do is give back at least enough to get them down below the $750,000 single audit thing. And then on single audits, and you're going to tell how dumb I am about these. I think there's 3 different types of single audits that you can do. One of them is the full-blown single audit, which I don't think RHCs would probably have to do that. And then there's a sort of the middle ground single audit that probably would work for RHCs the way I read it about that. So whenever you're getting Kraft Brothers to do, or Kraft Brothers is the old name, Kraft to do your single audits, ask them about the 3 different types and which one will be best for you.
Yeah, and the big thing with kind of the single audits, it's a little complicated because normally these relate to federal funding. So normally only non-for-profits have been subject to having to have single audits done. So if you're a for-profit entity and you received over 750, it's kind of just a new concept. So it's kind of just been a learning experience for everyone, even like some of the biggest accounting firms in the world. So we will look at your specific scenario and kind of assist you with figuring out what makes sense. But yeah, the single audits have not been super clear because, like I just said, for profits typically have never had to do them before.
Okay. All right, Jordan, well, thank you very much. I am going to make Trent the presenter here. So Trent, you are up next.
All right. Let's see here. What are y'all seeing?
Just you're just a blank blue screen right now.
Okay. How about now?
See you. There we go. Now I see it. Now it's good now.
Okay, perfect. So as Jordan mentioned, he works for Kraft CPAs, and we're in the same building. He's right down the hall from me, but I technically work for Kraft Healthcare Consulting, which is an affiliate company, partially owned by the firm, partially owned by Scott Murdy, who I work for. And we focus on the consulting aspect of it. Just want to minimize that real quick. We focus on the consulting aspect of healthcare, primarily in reimbursement, operations, and compliance. Personally, I work almost exclusively with cost reports. Lots of preparing, a little bit of reviewing, and also one thing that we do is a CCRS boot camp, which is Certified Cost Reporting Specialist. And we go and we teach it at different locations about what cost reporting is and how it works. And so if that's something you're interested in, feel free to reach out. Let's see here. What we're going to talk about today is Medicare Bad Debts, and this is ordinarily part of our CCRS bootcamp. It's usually about a 45-minute session. I'm going to try and condense it down and hit the highlights, get the good parts of it, and we'll see what we can do with that. Real quick, that's me. Like I said, I work for Craft Healthcare Consulting. There's my contact information. If you'd like to get in touch, shoot me an email, give me a call, whatever you need. If there's any questions that you either think of later after our question period or anything else that you would like, feel free to shoot me an email. Not a problem at all. So we're going to go ahead and jump in on the Medicare Bad Debts portion of this. Like I said, we're going to kind of condense some of this down, hit the highlights, hit a broad overview. But if you want to dig into the details of what you're looking at when you're looking at Medicare Bad Debts, this top line here is a great resource. This is basically where you're going to find all of the regs and anything in the provider reimbursement manual, which is specific to Medicare Bad Debts. Well, the first thing we'll look at here is kind of definitionally, what are we looking at? So an allowable Medicare bad debt, according to CMS, is a bad debt resulting from deductible and coinsurance amounts of covered services which are uncollectible from Medicare beneficiaries. So that's the definition. That's whenever I'm looking at anything, I always like to start with the definition. So that's where we're looking at. That's our starting point for what is a Medicare bad debt and what do we need to know about it. Another important aspect is it's currently reimbursed by Medicare at 65%. And it is reimbursed at 65% because of this Middle Class Tax Relief and Job Creation Act of 2012. It was signed into law by President Obama. And on this slide here, you can see just a couple of important dates related to that. But the important thing that we are concerned with is what it did to bad debt reimbursement. So this is back, I guess, just about 10 years ago now. But it changed the percentages that bad debts were reimbursed at. So certain provider types were not impacted immediately, where it started reimbursing at 100%, went down to 88, 76, and 65. This is where most of you probably were as RHCs. You got a little bit of a slower decline, whereas Medicare certified hospitals were immediately cut to 70% and then 65 from then going forward. But as of right now, 2015 and later, everyone's being reimbursed at 65%. So that's where everyone's at, and bad debt is all lined up in that area for reimbursement wise. So now that we know what it is and how it's reimbursed, we'll dig in just a little bit deeper into what constitutes Medicare bad debt and what the criteria that CMS and the MACs are going to look for when they're looking at your cost report and your logs, and if they were to take a sample, what kind of documentation might they be asking for? So as I said, this first point here basically just rehashes that definition we gave a minute ago. This debt must be, or the debt must be related to covered services and derived from deductible and coinsurance amounts. In point 2, the provider must be able to establish that reasonable collection efforts were made. We'll get into what this means in just a little bit. We're going to talk about reasonable collection efforts, and we'll kind of dig into what that means. I'll go ahead and point out points 2 and 4 are kind of connected as far as sound business judgment, establishing that there's no likelihood of recovery at any time in the future. If you're going through reasonable collection efforts, and you still don't receive anything, then that's one way of showing that sound business judgment to establish no likelihood of recovery. And then point 3 here is that the debt is actually uncollectible when claimed as worthless, and this basically just tells you what accounting period and what cost reporting period you're going to be including the bad debts in, and we'll briefly touch on that. So we'll go ahead and dig in here. Like I said, we're going to talk about reasonable collection efforts. So we're going to kind of talk about what you're going to be looking for and what you're going to be trying to create as far as documentation is concerned to back up your bad debt logs that are getting submitted with your cost reports. I kind of take a wide view of things and then drill down. And so what we're starting with here to look at what a reasonable collection effort entails is that you have to ensure that the effort to collect Medicare coinsurance and deductibles must be similar to the effort put forth to collect comparable amounts from non-Medicare patients. So when it comes to collections, we're going to treat your Medicare patients the same way as everyone else, as far as sending out billing and follow-up bills and letters, so on and so forth. As far as collections go, they have to be treated similarly. Otherwise, it wouldn't be considered a reasonable collection effort, and Medicare could deny the bad debt claim. But we'll dig into a little bit more of what this means as far as having a reasonable collection effort and things that CMS says it must involve. So the issuance of a bill on or shortly after discharge of the beneficiary, this is something called timely billing, and the correspondence isn't exactly clear on how much time is involved in timely billing. I've heard it said 90 days and 120 days before, but in reality, you don't really want to wait that long anyway if you can possibly help it. You want to issue the bill as absolutely quickly as possible. First of all, because if unnecessary delays in sending a timely bill could result in a disallowance of the bad debt claim. But there's also another reason, which I'll get into in just a second, as far as why you really want to get that first bill out as close to discharge as possible. You also have to. It also must involve what's called a genuine collection effort, and this is going to include subsequent billings, collection letters, telephone calls, etc. Like I said, anything that you would ordinarily go through your collecting process is something you want to include. And point 3 here is that the use of a collection agency can be used in addition to or in lieu of your reasonable collection efforts. So the use of a collection agency in and of itself can constitute reasonable collection efforts. And we'll go ahead and well, I also want to point out this note here at the bottom. You must document the collection effort in the patient's file by copies of the bills, follow-up letters, reports of telephone and personal contact, etc. And the reason I want to point it out is because in healthcare, we kind of have this saying of if it wasn't documented, it didn't happen. That's doubly and triply true for Medicare bad debt. You want to have the support for every line on your bad debt log, because it's entirely possible that when Medicare gets it, they'll decide to take a sample of it and will request to see that support, and you have to be able to provide that in a timely basis. So always, no matter what you're looking at and how you're including it on the log, always have your support for that inclusion. So talking about using a collection agency to constitute your reasonable collection efforts, this is just a quick note here on how this works from like a numbers standpoint. Whatever the collection agency collects from the patient, that has to be the amount that it offsets what you claim on the bad debt log. And so what that means is you can't like less out any amounts that are paid to the collection agency as a fee or a percentage or anything that the collection agency keeps. That's just considered an administrative expense, and that'll be included that's an allowable administrative expense on the cost report, but it's not something that can go on the bad debt log. You can't double dip that, if that makes sense, because it's already been collected from the patient. You can't then go and claim it for Medicare. And you can come back in. I think you have access to these slides. You can come in and see a little bit more of how that works. So this is what I was talking about as far as timely billing as a part of reasonable collection efforts. You want to get that first bill out as quickly as possible, because one of the things that constitutes reasonable collection efforts is having 120 days from the date of first bill. You have to continue your collection efforts for a 120-day period. So if you start that bill earlier, if you get that first bill out as soon as possible, then if you don't receive anything from the patient, it more quickly gets through that uncollectability time frame to where it can be included on the bad debt log. So it's critically important that you get that first bill out very soon after the discharge. or after the visit occurs in the case of RHCs. But let's see. And it's also important to note that any payments you do receive from the patient will restart that 120-day uncollectibility timeframe. So that's something important to keep in mind. So we've talked about reasonable collection efforts and what that means and how that works. There are some situations where you don't have to go through the entire 310 procedures for reasonable collection efforts, and we'll talk about a few of those kind of real quick here. The first one to understand is indigent patients. If a patient is deemed indigent by provider standards, then it's important that it's by provider standards, and there's a conclusion that no improvements in their financial condition have been made. The debt can be deemed uncollectible without having to go through the whole 310 procedures that we were talking about just a second ago. Excuse me. And this is just kind of a guideline as to what that internal policy has to look like from the provider perspective. So this indigent status, first of all, has to be determined by provider standards. You have to have that set out in a policy. And then for any patients that meet those conditions set out in your policy, you can determine them as indigent. And that policy has to analyze assets, liabilities, expenses, and income, and must determine that no other source other than the patient will be legally responsible. And the patient's file must contain documentation supporting the determination. So as I said earlier, and as I'm sure I will continue to harp on, documentation matters. You have to have the support for whatever methodology you're using to get the account on the bad debt log. You have to have support for that. So in this case, you have to have the documentation supporting the indigency status. Similarly and related is if you have a Medicare patient who is Medicaid secondary, sometimes called a crossover. In these situations, generally, there's specific situations as far as how much Medicaid is going to pay, but from a very general standpoint, you have to send the claim to Medicaid, and then they will either send back a denial or a partial. They'll pay a portion of the claim, and then whatever's left that they didn't pay, that can then be put onto the bad debt log for Medicare. So if there's deductible and co-insurance amounts that Medicaid pays, those are not allowable, and then anything that's left that they don't pay, that would be considered allowable. And there's a few slides here that basically just kind of go through that, and this explains the different situations involved in what that looks like. Some states have what's called a ceiling, where they'll only pay up to so much, and then that will be, and the leftover, of course, is what is payable by Medicare on the bad debt log and what you can claim on the bad debt log. But as I said, any portion that Medicaid doesn't cover can be included and paid by Medicare. So real quick, we'll look at a quick example here. Now, shout out to Mark for providing this for us as far as an RHC specific example. As I said, this is actually part of a bigger session that's related to cost reporting more generally. So I believe the example that I had in here was related to a hospital, but we were able to get a RHC specific example set up for y'all. So the things to note: you got your charge amount, your $30 copay, and then Medicare is going to pay $90, which is an 80% of the all-inclusive rate. And then Medicaid has a different rate than Medicare, and they will pay up to that rate. So if Medicare's already paid $90 and Medicaid's going to pay up to $110, they'll cover that extra $20. And so if the copay was $30 and Medicaid paid $20, the remainder crossover bad debt is $10. So that's what you would claim on your bad debt log. And then, as we've said at the beginning, Medicare reimburses at 65%. So $650 is what you'd actually get back from those bad debt claims on the cost report. So that's what that kind of looks like. And now this is important as far as documentation goes. As I was talking about earlier, you send the claim to Medicaid. They'll pay a portion of it or none of it or whatever they pay, And then whatever you receive back from Medicaid, you have to keep that documentation to show that you did file that claim to them first for your documentation for your Medicare claim on your bad debt log. So you make sure you have that documentation that proves that you did claim to Medicaid. So I mentioned earlier that one of the important things to note for what Medicare bad debts were and how they were supposed to be recognized is the correct period. So this is just kind of get into that real quick. Uncollectible deductibles and coinsurance amounts are recognized as allowable bad debts in the reporting period in which the debts are determined to be worthless. So if you're doing reasonable collection efforts, then as soon as that 120-day period is up, that's the point when they're considered worthless, and that's the whatever cost reporting period that the end of that 120 days falls in. That's the reporting period when you can claim those bad debts on the log. But if you're getting it on the log through indigency status, then whenever the patient is determined to be indigent, then that those claims can be put on the log at that point. And then for crossovers, whenever you receive back from Medicaid, you can include those on the log at that point. As with everything else, documentation is key. So have your usual accounts receivable records and keep those maintained to support your bad debt log. If you do have recovery of bad debts, which does happen occasionally, the reporting practice for that is just to reduce whatever your claims in your current period are by whatever your recovery is. So if you get back a certain amount, you would just reduce your current period claims by that amount. It is important to note that you do not have to reimburse, you do not have to reduce your costs or your bad debt logs in the subsequent period more than you were actually reimbursed in the prior period. So if you've already been reimbursed by Medicare at their 65% rate, at their 65% reimbursement, then and a patient comes in and pays 100% of what was owed, when you're reducing your claims on your bad debt log, you only have to reduce by the 65%. You don't have to, the Medicare initially reimbursed you with. You don't have to reduce it by the full 100% amount because Medicare didn't reimburse that initially. If you do have partial payments, and I'm not totally sure that this is incredibly applicable to RHCs because you've got that all-inclusive rate, so you don't have as much of a Part A, Part B split. But just for the sake of education, if you do have a payment that comes in that could be applicable to either Part A or Part B, and it's not made clear what it's applying to, you just apply it proportionally to what's owed, and then the portion that's applicable to Part A is what would go on the cost report, because the cost report is, of course, only applicable to Medicare Part A. So as we're kind of finishing up here, I want to take a quick look at what the log itself looks like. If you've been doing cost reporting or bad debts or anything in that area for any period of time, you've probably seen this. This is what we're all used to. This is what we've seen for years now. I will say that it's not currently active, but this could possibly come down in the relatively near future as a new bad debt log where we have to keep track of things. CMS just recently came out with Transmittal 17, where they updated some clarifications and some regulations, and it was initially thought that this might be included on that. It was not included on Transmittal 17, but it is expected to be a part of Transmittal 18, and at some point in the near future, the draft of that transmittal will come out and there will be a 30-day comment period regarding it. But if it does come down and it does become regulation, it's important to be aware of it, to know that it's going to happen. I will say that most of the columns on this were either on the previous log, or it's information that you would probably have anyway. We'll go ahead and go to the next slide here because I like this graphic because it highlights what's actually new. Most of this is stuff that you will probably already have, but there could be some things that you might have to dig a little bit more to obtain. So it's just important to see what we've got. We're running pretty close on time here, so I will let you come back in and look at that as necessary. And also here's a bad debt log checklist. Once again, I won't go through every individual point, but this is something it's a good tool to keep in mind and to have when you are going through your bad debt log before you're submitting it to your cost report preparer, and understanding, okay, what has standing to be on the log, what doesn't need to be on the log, and making sure you're including everything that you can and not including the things that you shouldn't. There's 2 pages of that checklist. But if we've got any questions, feel free to ask now, or shoot me an email, or whatever works for you.
All right, Trent, thank you very much. That was awesome. You did great. Do have a couple questions here related to it, so let's see if we can get these real quick. One thing I do want to remind everybody too is make sure you do this in the form of the Excel spreadsheet. You don't want to go through what Trent did one summer, which was putting in 40 or I don't know how many, it was like 40 or $50,000 of bad debts that we had to put in an Excel spreadsheet for a client that did everything in paper. So I'm sure, Trent, you have fond memories of that, don't you? that horrible summer. But here's your question. So do it electronically. That's number 1. Number 2 is we send 30, 60, 90-day letters, but we do not keep a copy in the chart. We do note that we sent them out in the patient account notes. Do we need to have the letters as backup documentation?
My rule of thumb would be to keep everything as far as what you're using. Medicare, CMS could come back in, well, really your MAC could come back in and ask for whatever you've got as far as bad debts go. Having the repeated 30, 60, 90 letters, that's going to support your subsequent follow-ups. I'm more of a better safe than sorry kind of guy. So it would be, my assumption would be to keep it. But if anyone has any other kinds of policies, that's obviously defer to what makes sense.
Yeah, I think, I mean, that's sort of an outdated sort of concept of actually having to keep the paper. So I think what you want to do is, and I agree with Trent, it's better safe than sorry to keep it, but sometimes it's just not realistic to print off every single statement and put it in every single file. I mean, everything's done electronically nowadays. So you should have some type of system that has a revenue cycle that says, I'm going to send Trent a bill on 30 days and 60 days, and here's what the bill is going to look like. It's going to be within your computer. And so obviously you have to have at least that documentation. I've been doing this 35 years. I've never actually seen them actually come in and make us show them a piece of paper that says we've, copies of our statement. So
yeah, and if I could jump back in real quick, of course, if you've got that from an electronic perspective, then there's no real reason for you to keep the actual physical paper copies. But having something that you can provide electronically would perfectly applicable.
Yeah, and you probably, if you can print off some of them to show them, okay, here's what we do. Here's our 30, 60, 90 day, and here it clicks a little box in our computer system that says we've done this. To me, in 2020, that's reasonable. In 1977, we would have had to have paper to do stuff. Okay. And then our Medicare Advantage plans, can you claim Medicare bad debts that you had from a Medicare Advantage plans? It says if so, is there a process requirements for this process? Trent, you had an answer.
Yeah, if there is a process for it, I'm not aware of it. I know as far as cost reporting bad debt logs, you cannot include Medicare Advantage or Medicare HMO, any of those associated plans, because from a practical standpoint, as far as the cost report is concerned, they aren't Medicare. They're not Medicare Part A, so it would not be included with this. Of course, like I said, if there is a system for that, I'm not aware of it.
Yeah. Okay, the next question is, if the Medicare patient has a secondary insurance other than Medicaid that does not pay, and then we bill Medicaid, and they don't pay either, can we claim those balances? You know, in this case, you had a Medicare deductible $213. The supplement didn't pay, and Medicaid didn't pay. So,
I mean, I would think you would claim that on your log. Have the documentation where it was denied by the secondary payer, have the documentation where it was denied by Medicaid, and then just make sure you've got that. And then I don't see any reason why you couldn't claim that on Medicare bad debt.
yeah, that would be my answer too. Okay, can we count it on the cost report if Medicaid doesn't allow the charge or it was denied? And
so Medicaid denied the charge?
yeah, I was gonna say, if it's a crossover, you're probably okay. If Medicaid is primary, then you're not gonna be able to claim that. Does that make sense? So because what will happen is you're gonna have a Medicare, you're gonna bill first, and then Medicaid is gonna be your dual eligible or your crossover. And a lot of times we bill it, and Medicaid will say we're not gonna pay any of that crossover, that deductible or copay. That's when you can put it on the cost report. But if you have a Mark Lynn as a Medicaid patient and that's primary, and you bill it and it gets denied, that's not a Medicare bad debt in that case. Okay, does that make sense? Okay, let's see here. Okay, and let's see here. Jody, can we count on the cost report if Medicaid doesn't allow the charge and it was denied? Again, if Medicaid's primary, you're not going to be able to do that. So, okay, is there any more here? Whoa, this is a hard one. What about telehealth visits? I haven't figured out telehealth yet. That is a good question. I haven't thought about that.
I'm not sure how that would work specifically.
Yeah, let's see here. They denied due to the procedure not being allowed. Yeah, Jody's getting a follow-up question there. Yeah, I don't know if Medicaid was primary or secondary. So, okay, I think that's everything. What's that? Go ahead,
There's
Danny.
one more question that I think a lot of people would benefit from. I'm going to read it out.
All right, Danny.
Sorry, this is just one that gets asked a lot. I'll hurry.
No, it's okay.
We have our 30, 60, and 90, and then final bill, then to collections. Are you saying that at the 120 days we can write off to bad debt? Second part, is it appropriate when we send the other accounts to collections and not send Medicare patients?
No. Let me start off with this one, and then you can chip in on it. Number one is you don't have a Medicare policy. You have a bad debt policy, or you have a collection policy, but you don't have a Medicare policy. You cannot treat the two different payer types differently. If you turn over that sorry Mark Lynn, if you try to collect for 120 days and then you turn over that sorry Mark Lynn to the collection agency, you are still having a collection effort. You cannot put that on your bad debt report if you're still trying to collect that money from you. You have to cease collection efforts. So that's my answer on that one. Number one is you can't treat anybody. You can't treat the two different payer classes differently. You can't have a Medicare collection policy. And number two is if you turn over a collection agency, you are still trying to collect that money, and that's not a Medicare bad debt until the collection agency says, that sorry Mark Lynn lives in a van down by the river. We can't find him, and they give it back to you. That's when when you cease collection efforts, that's when you can put it on the bad debt report.
Yeah, that would be what I would say too. Really, it comes down to you have to make a decision as to what policy best benefits you, depending on what your payer mix is. Because Mark's right, you have to have a policy that is across all payer types, whether it's Medicare, commercial, Medicaid, whatever. And so if you're in a situation where maybe you have a lot of Medicare in your payer mix, then maybe it would benefit you to have your policy be, we do 30, 60, 90, 120, and then if it's not Medicare, you wouldn't do anything more after that. But if it's Medicare, then you put on your bad debt log. But if that's not the case and your payer mix is shifted elsewhere, then it's probably going to be better for you to have a policy that sends the patients to collections, gets what you can, But then once they come out of collections, you know, whether if it's whatever amount was not, you know, recouped, then if it's a Medicare patient, you could put it on the log at that point. But yeah, I completely agree with Mark on that.
One thing to note, Mark, feel free to correct me if you disagree, but you could make a threshold amount. So, because typically your copays and deductibles on the bad debt that you're claiming are lower amounts. So you could say anything under $30 after 120 days, we write it off for all payers. But anything over that $30, we send to collections. So that's one way you might be able to capture some without separating payers, if that makes sense.
Yeah, there's one thing that, and this is, I'm brand new. It's not out there that much, but I know that one consulting firm got in trouble for telling clients that you could have a small balance write-off of like $5 or less. And so, and OIG wrote up this report, and it was just last week. So it's really not that well known. I think it came from Trent, the compliance group where you guys do, where you do the meeting in Cleveland. So they sent out this little notice last week saying that this consulting firm got in trouble for saying you could do a $5 write-off. And I've seen that in the MAC, the Novitas and Noridian, they all tell us that you can set a small balance write-off number of $5 or lower and write that off because it's more trouble to try to collect than that. So I am very confused about that. We got to do a little bit of research on those small balance write-offs. So I would not be doing those until we sort of figure out what's really going on that. Trent, did you see that? Did you see that thing last week on that, or did you?
I didn't see it specifically, but I certainly believe it.
Yeah, it was a very short blurb, and I was like, that's not what I've known. So because it sort of scared me because like I've told people that for years that you could do that, and it's on the Noridian Novitas website. They talk about small balance write-off, so I was very confused.
Yeah.
Okay, Danny, you got more?
I think that covers all of them. Autumn's was very similar to the one I just asked. There's one that says, what if a patient has Medicare Part A benefits only, so no copay or deductible was assessed, just a zero paid claim? Could the balance be claimed on the bad debt log after it was attempted to be collected?
Yeah, I don't think so.
I don't think so. Bad debt has to be deductibles and coinsurance. Bad debt's, I mean, as far as this is concerned, it's only Part A, but it has to be deductibles and coinsurance.
Yeah, that's right. That's right. And the weird thing about this is we say this is Medicare Part A. It's actually, the claim actually is paid through the Medicare Part B trust funds. One of the most confusing things about rural health clinics is the funding is really through Part B, but it's paid for through a Medicare Part A cost reporting UB04 sort of form, and it causes things to be very, very confusing and stuff like this. So, okay. 2:13, we're a few minutes over. Trent, thank you. It's so great to see you.
Great to see you too.
Congratulations on your fantasy football championship. You beat me like a drum. And thank you, Jordan, for pitching in today and helping. Thank you, Scott, for allowing everybody to join us. And Danny, thank you as always for all your help. And thank you, people, for what you're doing. Stay safe. And we appreciate you very much. Get your cost report stuff into Trent, Scott, Mark, Danny, so we can get working on your cost reports. Bye, everybody.